Hi, everybody. Thank you very much indeed for joining us for another episode of CFB Talks Digital Assets. Today, we are joined by CF Benchmarks' Head of Product, Ghando, who is going to talk us through the new CF Bitcoin interest rate curve, the first comprehensive interest rate, borrowing rate for Bitcoin, published by a regulated benchmark administrator. It's really something quite special. And of course, we are also joined by my friend and colleague, Gabe Selby, CFA, our resident in-house analyst, and it's going to be quite an interesting talk. So, Ghando, thank you very much indeed for joining us. Can you talk us through, right from the very, very beginnings, of what exactly the CF Bitcoin interest rate curve is and what it does?
Sure. So yeah, first of all, great to be here. Thanks for having me, guys. And yeah, I'm pretty excited to tell you about and tell the world about a bit more about the BIRC, the Bitcoin interest rate curve. At a glance, it's really a measure of the time value of Bitcoin. So that's the headline. If you want to think about Bitcoin as an asset, like any other asset in the world, it has a time value. And we're trying to reflect that time value for people to have a better understanding of how to think about this asset and how to think of it over time.
Yeah.
Right.
Hey, Ghando, no, it's great to have you here. So when we say time value, that's, a pretty jargony kind of finance term. How would you explain that, I guess, to more of like the layman when we talk about time value and time value of money and how we should discount assets in the future?
Yeah, sure. So, I mean, at any point in time, no matter what asset you have, there's a price for that asset today, and there's a price for that asset tomorrow. And you essentially have choices between things that you own, things that you want to buy. And a dollar, for example, you can invest a dollar and get a dollar plus something else tomorrow. So you can get, more for your dollar over time. And in the same way, you have gold, you have commodities. Everything really in the world that has prices over time essentially has a price today and has a price later. And that is a reflection of its value over time. It sort of encapsulates the utility of any asset. It encapsulates the scarcity and various other elements as we'll discuss.
Sure. And Ghando, just to really nail it down in people's understanding and perceptions, I think if we talk about it as analogous to, quite well-known interest rates or borrowing rates, well-known within the financial community, like Euribor, before it was deprecated, LIBOR, and its replacement SOFR, if that's the correct way of pronouncing the acronym. Is that the kind of thing that we're looking at, or is it so discontinuous with conventional lending rates that we really can't think of it that way?
Yeah, there are similarities and there are differences, but the way people should think about it is this is done from the perspective of a Bitcoin holder. So the starting point is, I'm hodling some Bitcoin. And the question is, do I have to just keep it in a cold wallet, or can I earn something on that Bitcoin? Because that Bitcoin has value over time, let's say positive value over time, then I should end up at the end of the year with maybe 3% more Bitcoin than what I started the year with. So in that sense, it's analogous to LIBOR, where from the perspective of the asset holder, somebody who has already Bitcoin, what can they do with it to earn more Bitcoin by the end of the year?
Wonderful. Perfect.
Yeah. And when we think about, traditional asset classes, time value, discount rates, stuff like this, I think what's important here is we've got, these commodity type assets, which in large, a lot of people consider Bitcoin to maybe fall under that sleeve to some degree. And that these assets, I think it's a bucket that we would consider to be like a non-carry traditional asset. So when Ghando is talking about how do we approach the BIRC, the Bitcoin interest rate curve, what's its significance for a Bitcoin holder, someone who's strategically long Bitcoin? Well, it's something that technically adds a new element that is pretty novel to that type of investor, because you finally have some sort of mechanical mechanism that's going to generate, a positive carry to an asset that before really, there was no alternative, or there was no option for that. So that's where I think it's important to highlight.
And some of the stuff it unlocks is we say, like it's going to unlock all the debt markets and credit markets and help all of these markets function. But to take a step back for the users for a second, like somebody might say, well, why should I care about debt markets, right? For Bitcoin or for the crypto ecosystem? Like, who cares? I just want to buy these coins and they go up in value over time. And that's fine. There's nothing wrong with that. The difference between buying something for the long term or for the short term is that you are you're taking all the upside and you're taking all the downside, right? So that's no different than buying equity in, the McDonald's company, right? And if McDonald's stock goes up, it goes up, and if the company crashes, you go down with it. That's what debt is taking all the upside and all the downside. Debt, on the other hand, that's all equity. Debt, on the other hand, is the way for the world to slice risk and reward and have somebody come in who might not necessarily be wanting to take all the upside risk and all the downside risk. They want to have a slice of risk and a slice of reward. So they take very limited risk and maybe only take like 3-5% of the reward. And that's really, really important in bringing more people into the ecosystem that can play different roles in different parts of, the functioning of the whole markets.
Sure. So essentially, and you can actually put this in perspective probably better than any of us, Ghando. What the CF BIRC actually represents is probably the first comprehensive attempt to provide the facility to have an insight, visibility into an overall lending rate, a borrowing and lending rate for Bitcoin. Really to actually be the equivalent in cryptocurrencies, or at least Bitcoin, to these interest rates that we mentioned earlier. Is really that the kind of scope that we're talking about here?
Yeah, and it actually goes, beyond Bitcoin, because what happens is, as you've seen in the crypto market so far, there's protocols over here like doing DeFi things, maybe with yields of like, 30%, 50%, sometimes over 100%. And there's nothing for people to look and say, okay, where's my guidepost? Where's my baseline? And why are these guys giving me, a 200% return and yield on my money? So I think the space, as we've seen, and because of the problem with like centralized lenders and stuff, the whole thing is incredibly fragmented. Not everybody has the same information. Capital doesn't flow efficiently across like all parts of the ecosystem, and that fragmentation and asymmetry of just information is causing a lot of secluded places for bad actors to do things, and sometimes even just not transparency for like regular participants who want to just try to make like some money, but they see like 30% and you're like, oh, maybe there's 30% is reasonable. Maybe it's not, but how do you in traditional finance, you have, the Fed funds rate, like, and then everything builds as a spread to that. And that's what we're trying to provide, is something that acts as a benchmark that people can measure risk reward against it.
I think that's where, as a benchmark provider, that's where I think it's a great opportunity to kind of step in, really look at the problems that we're trying to solve with BIRC, and say, okay, well, we've got, our BRR, in Bitcoin Reference Rate Index, which settles all the CME futures on Bitcoin, right? And we understand how carry trades can generate, positive yields for investors, institutional investors that are trying to, generate some sort of, let's just say like a yield or coupon generation on that strategy. So if we can take, the inception of the BRR through the venue of the CME futures and kind of get this implied interest rate, right, that is grounded to reality, that serves as a good baseline rate where institutional players can, look at it and say, well, I can this will be my benchmark. This could be my floor. And I can use kind of some subjective, additional layering based on other costs of capital to adjust that final rate and have a more realistic, grounded to reality interest rate for users.
It's like the S&P 500, right? Like if I'm investing on my app, like even if I'm not like a professional who's benchmarked to the S&P 500, I want to know, am I doing well? Maybe I'm buying, Disney, and Disney is like maybe a more risky stock, or Netflix. They're more risky than the S&P 500, but I expect to make more money than the S&P 500, right? So that's my baseline of, reasonable, maybe minimal risk and reward. But then I can price and think about everything else in relation to that. And if something is promising me more return, it probably comes with more risk, and I can think transparently about what those risks and rewards are, rather than having it in this like dark room that is the crypto world where everybody's like trying to feel their way, but information is so scattered and the activity is so fragmented and the liquidity is so fragmented that it's hard for people to think about those things on the same terms. And one of the things, by the way, is standard contract terms. Like in a lot of other spaces, you have standard terms. It helps people do transactions more easily because they say, okay, we're going to do this deal and it's indexed to the S&P 500 plus or minus, or indexed to Fed funds rate plus or minus, and that just facilitates better communication, more efficient transacting. You need that kind of guidepost for everyone to then think from within.
Sure. So that particular point that you made was actually really good that you made it right then, Ghando. Standardized contract terms. That's one way, one thing that makes the CF BIRC a much better solution than what we actually have right now. And what I want to get onto, because this will enable us to have a little bit more insight into the BIRC itself, its construction, and so on and so forth. What else makes it qualify as this, what we expect to become the universal Bitcoin interest rate curve, or set of borrowing rates? I know you've got some characteristics which you want to expose here.
Yeah, I mean, it's the same characteristics that we hold as principles for everything that we do, and they are that it's representative, replicable, and resistant to manipulation. So resistant to manipulation, very easily. It's about integrity, and we have to have the proper guardrails to make sure there's no bad actors that can influence the benchmark. Sure. Representative is really around that it reflects the world, right? Like there's a lot of people that have, when they think about some of these things, they say, oh, I'm going to run some statistics and I'm going to do this modeling and look at the regression and stuff. And that's great, but it's not always reflective of a point in time. It's like backward looking. We're trying to say that this thing is going to get published every day and it reflects what's happening today in the world, right? Agnostic to the ups or downs.
Sure. So, the fact is we're talking about a Bitcoin interest rate. So obviously it's going to be quite convoluted. Nevertheless, I think in principle, we can sort of get at the ideas behind the mechanics, if you like. So how do we actually represent that economic reality that you're speaking about? How is the BIRC put together?
Yeah. So I'm a guy who's got, hopefully one day, maybe 10 Bitcoins. So the question for me is, what can I do with those Bitcoins, right? Every day I wake up and they're sitting there and I wish I can do something with them, right? So what do I do? The one thing I can do that's, very straightforward is I can go lend it to somebody else. Why would anybody want to borrow Bitcoin? Because maybe they're a hedge fund and they need to collateralize their accounts across multiple exchanges. They're not going to go buy like 1,000 Bitcoins. They just borrow them and to collateralize their accounts to then trade everywhere. So, or maybe they might have another reason that they want to borrow Bitcoin. So the most obvious thing is, I go lend it to someone. And obviously how much I charge them for that is a function of how creditworthy they are. Are they going to give me my Bitcoins back or not? So that is what we're reflecting using the OTC contributors. So we're engaging with OTC players that are engaged in the lending and borrowing of Bitcoin, and we're bringing that information every day into the rate. So that's one thing I can do as a holder of Bitcoin. I can get into the other one if you want.
Absolutely. I mean, I was going to say, could you tell me about the terms that I can borrow this at this rate? Is it just a day, or is it fully across what we know as the curve? I mean, I think it's the latter, but you can extrapolate.
So we're trying to reflect the value over time. So essentially, how much can I earn with my Bitcoins if I lend it out for a week? How much if I lend it out for, we have 1, 2, 3 weeks. We have for like a month, we have 2, 3 months, 4 months, all the way to 6 months, to 5 months. And so what that really gives people is that sort of the value over time, the whole term structure of the asset, right? Sure. And it gives people a more complete version of not just, the more immediate term, which has like liquidity and some other things that factors that play into it. It gives them an idea about sort of the medium term as well. If I give away my Bitcoin for, 5 months, how much can I earn? And sort of that is obviously governed by liquidity and what we can observe in the market, because we want to reflect things that are actually like trading every day. There's activity every day, nothing that's like esoteric and, something happens like once in a blue moon.
Sure. One more thing, I think Gabe wants to come in, but there's one more thing about the inputs. So we understand that there are OTC lenders. In terms of the sort of maybe the slightly longer term rates, we are probably looking at the CME, the regulated futures marketplace for Bitcoin, as one of the major contributors, right?
Yeah, so that comes to this sort of our second major source of data that we're looking at. So I said, if I have Bitcoin, I can just go lend it to somebody, right? That's one thing I can do with it. The other thing I can do with it is I might go collateralize myself on an exchange like the CME or another crypto exchange, and we have a cohort of exchanges that we're pulling data from, and say, okay, actually, I see that the spot is trading below the 1 month. So there's contango in the market. That means that I can buy the spot, sell the future at like maybe it's $100 worth of a premium, and I can wait for a month, and these two converge at the end of the expiry of the future, and I've just collected $100. And I can convert these $100 back to Bitcoin, add them to my stash, and I've just now ended up with more Bitcoins in a month than I started with today. So that's another thing as a Bitcoin holder that I can do to earn more Bitcoin. And we're trying to bring that information through the transactions that are happening on the exchanges to feed back into this rate, because that is valuable information that people need to know to at least start thinking about the risk reward of what they can do with their Bitcoins over time.
Gabe, you were going to say something there, man.
When we look at the consensus mechanisms and the trends that we've seen over the past few years, a lot has switched over to this proof of stake model. Last year, we had Ethereum, the second largest cryptocurrency by market cap, also make that switch from proof of work to proof of stake. Bitcoin is, it's the OG. And I think it's fair to say that the foundation is going to, or the Bitcoin developers are going to maintain the proof of work kind of consensus mechanism. So it's very important to kind of understand why this novel concept of providing a grounded kind of index on Bitcoin interest rates, it unlocks another angle for Bitcoin holders in the long run to add some sort of coupon generation, some sort of yield generation, which changes the risk return profile slightly to be more advantageous. So while other tokens, of course, the newer ones are going to be using these proof of stake, these liquidity pools, and they're going to be, locking them up and generating some yield that way by, validating these transactions. Bitcoin holders, this is kind of like a whole new area, a new playing field for them to kind of participate and try and get some sort of, additional,
because there's no central bank that you can go put, Satoshi central bank, where you can go put your Bitcoins, and then 6 months later it gives you your Bitcoins back and like some more. We wish that existed. It doesn't. So in the absence of that, what's going to happen is you're going to have, DeFi or traditional finance participants come and say, okay, if you give us your Bitcoin, we can go replicate the BIRC, follow the methodology. Mm-hmm. And if the BIRC is saying that you get like 3% or 4%, you're going to get that 3 or 4%. So you're going to have these intermediaries that emerge that can execute this efficiently and then offer it to people that have their Bitcoins, whether they are maybe like clients of the banks or maybe clients of a smart contract where you can deposit your Bitcoin, similar to an AMM, but just more sophisticated and more involved, I guess, because you're trading through time. Sure. And you're able to like forward hedge some of these things. So in the same way that you can deposit your Bitcoin and get more Bitcoin net out at the end. So it's pretty exciting. I want to put my 0.001.
We all do. Now, just to riff on that a little bit, it's sort of like the idea that as an institution, for the very first time, you can come to this market and actually execute a strategy of that nature, the one that you described so eloquently, Ghando, and know that you've excluded all of the risk in terms of the counterparty, in terms of the price, in terms of non-standardization, and it's just down to your skill.
You've excluded most of the risk. Yes. Yeah, you've excluded most of the risk. So we are dealing with, a handful of exchanges, a handful of OTC participants. So we're trying to keep it so there's no risk free because there is no like central bank. No. But this is trying to kind of take away most of that counterparty risk. There's still some risk baked in there, but that's what we're working with because the Satoshi central bank doesn't exist.
Speaking of Satoshi central banks and the keyword, being central, I think, a lot of the community in crypto is always focused on this concept of being decentralized. And this is, I think, an interesting topic that maybe you can touch on a little bit is how can the BIRC fit into a decentralized finance world? What are some opportunities for maybe oracles to reference it? Or, you could probably, a few come to mind, I'm sure.
Yeah, I mean, a lot of the activity on DeFi is, at times pricing things. There's pricing of sort of what I would generally call like credit markets, right? Borrowing and lending activity, the liquidity pools, yield farming, all of these things actually fall under that umbrella of credit markets, right? And so far, all of these things are being priced as, it's 9% or it's 90% and numbers sort of just getting plucked out of like the specific tokenomics at times that are like make sense, but at times, they're just sort of like the number that works at a moment in time. And because you have some bad apples, what that causes to the user is the user's like, well, why is it this rate, not that rate? Like, how does that compare to this? And what we're trying to give the DeFi community also is, and we have, this rate, by the way, was developed in association with Chainlink. It's already kind of accessible on Chainlink's Oracle network. And that enables DeFi to say, hey, user, I am offering you this risk, this reward, and the yield is BIRC plus 7%, right? So now somebody can look at that and say, okay, I'm getting this like bump of BIRC. Let's say BIRC is 3% plus 7%, so I'm getting 10%. So I'm getting 7% over the BIRC. So now what kind of risks am I taking in this protocol to deserve that incremental 7%? And that transparency is huge, and it's severely lacking today. And I think it's going to go a long way in just getting that traction on trust and people having more transparency and more price discovery on what they're signing up for and what they're getting out of it.
Now, we've touched on, we're getting into changes of regimes of all kinds here, whether purposeful or inadvertent, and naturally, I mean, thinking about the current regime, the regulatory regime that overlooks our industry, it looks like before too long, and this term has been mentioned several times now, particularly out of Washington, the concept of the qualified custodian could become the norm. Now, in that kind of environment, with not just that sort of like mechanism in place, but maybe looking at that as a good example. How would the CF BIRC sit? How would it work? Would it be any different? What would be the implications for an interest rate of that nature?
Yeah, so we obviously keep a close eye on the regulations, as you guys know, and essentially it would limit your choice of who you can custody your Bitcoin with as you're executing some of these, the methodology. Essentially, you're having to transact on exchanges, so some participants are only able to transact on the CME, and with the new regulations, participants may be limited to having certain custodians to custody their assets. And that naturally sort of limits the sort of service providers they can work with. But it should get you at the end of the day to the same answer or something very, very close.
Sure. Now let's look in a world a little bit into the future where the CF BIRC does become, or it's on the verge of becoming. It really makes rapid strides to becoming the de facto universal Bitcoin lending rate. What would that world look like, very broadly speaking, in terms of the facilities that would be available, the use cases that would be possible going forward in that future?
Yeah, so I mean, the most obvious one and sort of the most important one in some ways is if I want to lend you my Bitcoin for a year, right? Yeah. At the moment, I'm like, yes, 7%, maybe it should be 8%. I don't know, but I sign with you at like 8%, maybe the world changes in a couple of weeks, right? And maybe you think 8% is like, oh, I'm going to commit to 8% for the whole year. What if the world changes? And as you've seen, our world keeps changing very quickly these days. What this allows us to do is to say, we're going to sign a contract. I'm going to lend you my Bitcoin, and it's going to be BIRC, let's say the 1 month BIRC, plus 4%. So therefore, we've established that you're willing to pay a premium above BIRC at 4%, and I'm happy for that to be my compensation. And now BIRC can float, and our contract can be, a function of the changing world. So we don't have to commit and be stuck with our decision today. We can have that flexibility where our contract is floating against the BIRC. It's BIRC plus. And as the world changes, then, it might be 3 plus 4 today, or it might be 10 plus 4 if the world changes significantly. And what that gives me as a lender, it gives me confidence that I'm not getting screwed. I'm not going to have FOMO in a couple of months that, oh my God, the world changes. I could have gotten way more for my Bitcoins. It just gives me that assurance, and it makes sure that you're paying me a fair price throughout the term of the agreement. And we've already heard that from OTC players that are in the borrowing side of things. They're saying, yeah, we'd be more comfortable to borrow Bitcoin on longer term horizons if the rate is floating, not fixed.
Sure. Ghando, I would say if there's any other specific use cases that you see that we haven't touched on yet that you think are worth highlighting, I think
glad you asked, Gabe.
Yeah.
Glad you asked. There's definitely one more. There's definitely a lot more actually, but the foundation, as I said, is that core sort of physical borrowing and lending activity, and that is our primary purpose because that benefits really everyone in the ecosystem. DeFi users are going to have transparency. Institutions are going to be able to go to their treasury and say, yeah, we're not making a number up, like it's sort of benchmarked to this as a spread to this. So that is the core, functionality. Now, once you have that functioning properly, then you can start having derivatives markets building on top of that, right? So you can have, say, I lent you my, same with like mortgage markets, right? Like I lent you my Bitcoin at BIRC plus 4%. Maybe BIRC has moved up to 10%. Now I want to lock it in. So I can go into the derivatives markets, transact through like a structured product or an exchange traded derivative to lock in the 10%. So my contract with you has not changed, but I can, if BIRC goes up, maybe I want to lock it in before it goes back down. And that enables me to do that. So essentially what that means is you start having risk management solutions, giving people exposures that they want and need or mitigating exposures that people are worried about. So all of these participants in the ecosystem, they can index to BIRC, and then now they have the option to use these instruments to hedge in and out of BIRC, which is unlocks options markets, interest rate swaps, and various things that will come to the ecosystem in time. This is just the foundational piece that we're starting with.
Sure. So I mean, the main takeaway that I'm getting from this really instructive chat, Ghando and Gabe, is essentially that, I think people need to grasp the significance of something like this. There's something like this is actually the CF benchmark's interest rate curve. It is essentially the key to unlocking the next phase of the, well, you could say cryptocurrency, you could say Bitcoin, as your mileage may vary. But without that facility, without that universal benchmark facility, a trusted lending rate, I mean, we really are, basically thinking that you cannot actually have the further development of the kind, including some of the sort of instruments that would be possible once you do have that lending rate. I think that's about the size of it, right?
Yeah, and I mean that markets, people, that when we loosely say this can unlock like the credit markets or the debt market side of the whole crypto ecosystem. That's really, really important because debt markets in the traditional world are over 300 trillion in size, or maybe a bit less now with the tightening, but they're enormous. And why should people care? Because debt markets is your mortgage, debt markets is your auto loan, debt markets is your credit card. All of these things are made, possible by this functioning of these credit markets that are able to allow people to come in and have a slice of risk and a slice of reward, not the whole risk and the whole reward.
Exactly. So essentially, you cannot actually have a fully functioning, fully diversified and universal debt market without a fully functioning universal Bitcoin interest rate curve. If we're talking about
that's exactly right. And right. The development of the credit markets will make the ecosystem as a whole better overall. It will bring more people in. It will increase adoption. It will increase people's, part of our mission is the economic freedom. It will, allow people to parse risk and reward in a way that gives them more tools in the toolbox to ultimately manage their personal finance.
Absolutely. Well, Ghando, I think I feel that we've covered pretty much everything. All that's left for me to do is say thank you very much again to Ghando, our head of product, for educating us about the CF BIRC.
Great to be here, Ken. Thank you.
And do come back again sometime soon. And of course, my colleague and friend, Gabe Selby, thanks a lot for your contributions as well.
Thanks, Ken. Great to have you, Ghando. Yeah, we got to get you back ASAP. Don't be a stranger.
Thanks, guys.
And thank you guys again for listening in for the latest episode of CFB Talks Digital Assets. See you again soon.